It's great to be back in Australia and to talk again about tax reform. Tax reform really came about in record time, and it came about in record time because we really had a perfect alignment of the parties in Congress and in the White House, all Republican, which allowed for the legislation to be pushed through in record time. We've seen some really major change in our U.S. tax system. The reduction in the headline corporate rate from 35 to 21%, the ability to expense on a current basis assets placed into service as opposed to depreciation over time, and a major rewrite of our international tax system, which introduces a type of participation exemption on dividends that are being repatriated back. I think to call it a territorial system in the classic sense, the way that you might see it in Australia or in the Netherlands or Luxembourg, is a bit of a misnomer. The reason is that on an annual basis, U.S. companies have to pick up on or account for on a current basis all of the income of CFCs. Now, a good part of that income ends up being exempt from tax, but at the same time, every year the income flows up into the United States, and once it is all accounted for, one way or the other, whether it's under our old CFC rules, under the GILTI regime, or under other provisions, then the income can come back to the U.S. without further imposition of tax through our dividend received deduction regime. So what we've seen in terms of repatriation is really quite a major impact on the ability of mainly U.S. multinationals to bring back cash from overseas. As a result of tax reform, to transition from the old system to the new system, we had the so-called toll charge regime, which imposed a lower rate of tax on earnings that had accumulated overseas. Now that that tax has been accounted for and companies are paying for it, they can bring that cash back into the United States for use for deployment in the US or for payment back to the shareholders. In addition, we expect that under the new regime, repatriation will be easier, not completely mindlessly easy, but easier to bring the cash back. Because once all of the income has been accounted for, it can be brought back subject to a dividend received deduction. So treasurers at U.S. multinationals will have an easier time accessing the cash that sits overseas for use back home.